Hi everyone, welcome to Module 6. For Module 6, you're going to be reading Chapter 13, Discussion Board number 5, and Applia work as well. You'll notice that Module 6 is going to be the foundation of the market structure, so it's very important to understand the role of production costs to ensure that you understand how production costs will influence a business and decisions that they have to make. For this week, with the discussion board, you're going to focus on 2 variable and 2 fixed costs that a fast food restaurant would experience. So explain 2 of these costs, analyze how a business can control these costs during both growth and recessionary times. So for this week, we're going to look at the role of production costs. And we start with production costs with profit. Profit is total revenue minus total cost. Total revenue is looking at how many units we sell times the price of the product. Total cost is looking at the total cost to produce those units of production. We divide profit into 2 different areas, economic profit and accounting profit. Economic profit is total revenue minus total cost, and it's going to include both explicit and implicit costs. Explicit costs are costs that we can account for, that we have a receipt for, whereas implicit costs are costs that we do not have a receipt for. Implicit costs are opportunity costs. Then we look at accounting profit, as accounting profit is total revenue minus total explicit costs. Accountants want receipts, so that's what we're looking at with regard to explicit costs. In this PowerPoint, they do give you some examples that you can calculate, and we look at the production function. But now let's look at the production cost. We deal with production cost looking at fixed cost. Fixed costs are costs that do not change when more is being produced. Examples of fixed costs would be rent. Another example of fixed costs would be salary. Doesn't change when more is being produced. Then we have variable cost. Variable costs change when more is being produced in an economy. In a firm. So if a fast food restaurant or pizza is trying to supply more pizza, you'll notice that their cost will increase. Total cost is fixed cost plus variable cost. Now, if you look here, you'll notice that fixed costs are the same for as many units as we produce. Variable costs increase as more being produced because we need more materials to produce more products. You'll notice that total cost will always change. Total cost changes because of variable cost. Now, marginal cost is going to be the change in an additional unit of total cost. You'll notice the change right here is 70. So when we produce nothing, our costs are 100 because of fixed cost. When we produce 1 unit, our costs are 170. Change from 1 unit to the next is 70. That's your marginal cost. Average fixed cost is fixed cost divided by output. You'll notice that average fixed costs are always decreasing. Average variable cost is variable cost divided by output. You'll notice that average variable costs are going to be in a U shape. They decrease and then they start to increase. Now, average total cost. Average total cost is looking at total cost divided by output. So to find the average of anything, remember this because you're going to have to find the average of 3 of them. To find the average of anything, you want to take whatever we're looking at, total variable and fixed costs, and divide by output. That will be able to give you what you're looking at. Now, let's put the cost curves together. If you put the cost curves together, I want to give you a little help here. This is going to be the marginal cost curve. The marginal cost curve is going to be looking like a check mark or like a Nike symbol. And then the top row right here is the average total cost. The blue line is average fixed cost, and this line right here is, average variable cost is the blue line, and this line right here is the average fixed cost. To find the average total cost, you could add the variable and the fixed cost. The difference between right here, the total and variable costs, you notice this difference right here will be average fixed costs. So those are some things that could be very helpful. Here's another thing, filling in the blanks. To fill in the blanks, this is could be very challenging to some people. But for example, you notice variable costs are going to be 0 right here. Total cost. Well, total cost is 50 when there's nothing being produced. So 50 plus 10, 60. And then 60 to 80, that would be 20. So you want to start with one column, and you might have to use other columns to get one column. But just start with one column to get really the things moving. I think it'll make it much easier if you can do that. Here's going to be the answers to that, and I think that'll be a good guide and maybe a really good exercise for your work as well to really assist with your efforts. And then you're going to have costs in the long run and the short run. Costs in the long run are going to be long run average total cost. You know firms will have to make production decisions, so make sure to look at that as well. Please use the resources that I have. If you have an additional questions or if you need additional resources, please let me know, as I'm more than willing to assist, and I can easily pre-grade your work as well.